Hi everybody, my name is Stephen Fish. I'm the Director of Canadian Business for Social Responsibility. I want to welcome you to our first webinar of 2015, Beyond Reputation Management to Sustainable Development, How the Equator Principles are Impacting Project Finance. There'll be just a couple of housekeeping items. If you wouldn't mind muting yourself during the presentation itself, that helps us, and then we can unmute you and for the question period at the end. That's helpful, just so we don't have too much distracting background noise. And otherwise, welcome you to listen in over the next hour. Just briefly, I want to thank CBSR and the Canadian Business Ethics Research Network. This is I guess we're kind of rolling into year 3 of an opportunity to present some new research that's coming out of the ethics community in partnership with CBSR, and putting that in front of a largely business audience at CBSR with the sole purpose of gaining feedback for the PhD candidates so that it furthers their research, but also giving some of our members and some of our supporters an opportunity to hear what's happening in the world of academia that relates to issues of social and environmental performance in the business community. So that was the purpose behind this Research Directions webinar. And I just want to thank Hillary and Wes at CBSR for both bringing us and including us in this opportunity, and for co-hosting and co-promoting this along with the Ethics Center as well. So that's it for me. I want to hand it over to Hillary just so she can set things up for today's webinar. And Hillary, will you introduce Emmanuel then?
Yes.
Okay.
I will.
Great. Over to you.
Okay, great. So my name is Hillary Martin. I'm the Research and Outreach Coordinator at the Canadian Business Ethics Research Network, CBSR. This webinar is kind of a follow-up to an in-person event that we have to bring PhDs and people in the business community together, and we have a number of partners who've helped us kind of source and bring those people into the conversation. So I want to actually thank the Ethics Center CA, the Canadian Centre for Ethics and Corporate Policy, downtown Toronto, as well as CBSR for helping connect us with over half of our advisors last year. Of our 20 advisors, over half came from business, law, and civil society. So I want to thank our supporting partners, so those two organizations, CBSR and Ethics Center. Also, Export Development Canada has been a real support for the PhD cluster over the years, and also this year in particular in sponsoring our knowledge mobilization program. So there is a link to a research snapshot, of Emmanuel's research that's up there, and we will be refining that with the support of the EDC. We'll be posting snapshots in our repository. Just a note, EDC was not actually part of selecting the topics chosen for research. Even though there's some overlap, there's a total distinction between those roles. Thanks to York and the Schulich School of Business as well, and in particular to the Social Science and Humanities Research Council of Canada for the great support for the knowledge mobilization work through the Connections program. So just a little bit of an overview of what will happen now. Taking the kind of in-person rich discussion with advisor input that we do in our in-person event, in this webinar, we aim to transpose that into an online environment. So what we will have is a 12 to 15-minute presentation from Emmanuel, 5 minutes of comments from both of our discussants, so including Chris Pullen and Chris Stevenson. I'll introduce them then. Then we'll have about a 10-minute discussion of within that smaller group, and then we'll open it up to 25 minutes of facilitated discussion. We will be taking questions from you, questions and comments from you. Our primary way of doing this is through the chat box, so if that fails, please feel free to send your questions and comments to me in an email, and we will be putting my email in the chat box so you'll be able to see With that, I will briefly tell you about our three panelist participants. Emmanuel is an Equator Principles researcher whose doctoral work examines the social and environmental outcomes of the Equator Principles in project finance, and he works on project risk management as well. He's at University of Waterloo's Faculty of Environment, the Department of Environmental and Resource Studies, in the Sustainability Policy and Governance program. He holds an MBA in Financial Management from Wilfrid Laurier School of Business and Economics. Chris Pullen is a Senior Environmental Advisor at Export Development Canada. He's been there since 2008, and he's a fish ecologist by training and professional experience. Christy Stevenson is with the Western Canada Division of Purpose Capital. Her expertise in the evaluation of corporate environmental, social, and governance risk and mitigation has been gained in part during more than a dozen years at Canada's leading sustainability investing firm, Sustainalytics, and NEI Investments. Thank you very much for joining us, and with that, I will hand it over to Emmanuel.
Thank you very much, Hilary, for that kind and warm introduction. And I would like to thank Stephen for facilitating this discussion here as well. It's a privilege to be here and to share with you one of the most important subjects of our time, the Equator Principles and its impact, if any, on sustainable development. As Hilary just indicated to you, my name is Emmanuel Acheda, or Emmanuel if you please. A doctoral student at the University of Waterloo, and my research is on Equator Principles and its implementation, particularly in project-affected communities. When I was coming for this presentation, my wife was asking me, how do you feel? I said, well, I feel a little bit excited, but I don't know how things are. Then she told me that, well, you remember the time when you proposed and you said, do I have a chance? And to which I responded to you that, well, maybe if you keep talking. So this is I hope that when we have this chance to discuss Equator Principles, we may therefore have a way of moving Equator Principles towards sustainable development, which in any case is its original premise or basis. I'll just give you a little bit of context about my research. Over the last 3 years, I've interacted with Equator Principles literature, and most of this literature spans the period from Equator Principles inception around 2003, although more exactly 2002. And this literature extends to almost early last year of 2014. And what has happened over this period is that, along with my advisor, Professor Olaf Weber, we published a review paper in as far as our preliminary findings were. And then in the summer of last year, I traveled to Africa, specifically Zambia and Uganda, so that we can have at least a preliminary empirical understanding of how Equator Principles is being implemented in that part of the world, specifically how the narrow conception of sustainability as being a confluence between environment and social issues is being actualized on the ground. But and what I found essentially from my interviews who were generally from mining industry and road infrastructure projects, as well as officers working with compliance in the environment, governmental agencies, was that there were the issues of stakeholder engagement, transparency, and host country environment, as well as, of course, reputation, as key issues which were really surrounding this discussion of Equator Principles. I hope that our discussion today will kind of add and enrich our debate as to how best to strengthen Equator Principles, from a mere tool for positive reputation, as some argue, to its intended purpose as a means towards sustainable development. So the question before us is, why do some stakeholders consider adoption of EPs in project finance as a case of reputation management rather than an attempt at sustainable development? And I suggest at this point that to get the answer to this question lies in understanding really the conception of EPs or Equator Principles. And I'll be using EPs as well as Equator Principles interchangeably just to speed up this. So it seems in looking at and interacting the literature, one of the key aspects in the issue of transparency and accountability as persistent criticism of Equator Principles as a contribution to sustainable development. And so it seems to me that my initial hypothesis at this time is that evolving some compliance authorities for effective implementation of stakeholders would probably be one aspect of moving this pathway forward. Now, in regard to Equator Principles, essentially then, as a standard for managing and administering environmental and social risks in project finance transactions, there are three key risks which Equator Principles signatories are very mindful of, or which Equator Principles Association itself seeks to bring within its control. And these are environmental and social risks, essentially, that projects might be subject to local resistance, or that there might be issues like pollution, both air pollution and toxic discharge arising from this project, or, for example, there may be breaches during dam construction and so on. And then, of course, related to this is what the collective observation of various stakeholders would have on the project sponsor in the way of reputation risk. And so these two risks therefore translate into the bottom line for a project sponsor in form of financial risks, because what that entails therefore is that there might be the accessing capital from various financial institutions for the project sponsor might become problematic, and that social resistance to the project might delay the onset of cash flows necessary to repay the funders for the project. So attending specifically to this risk is very important given the nature of project finance, because this is what's known as a non-recourse form of financing. So essentially, Equator Principles have evolved to address these problems, and it has moved from review and categorization of projects. Essentially, these are categorized into three as category A, B, C, and all these flow from international financial cooperation assessment and screening criteria, as well as moving onwards to social and environmental assessment, stakeholder engagement, and then obviously at the end of it all, there need to be a feedback towards stakeholders in the form of reporting and transparency, not just for the banks or the financing institutions themselves. So over the course of the last 12 years of evolution of implementation of Equator Principles, we see that initially we had 10 founding banks, most of them based in Europe and North America, and there were issues in respect of their funding activities, whether it was dams in Latin America or it was highways. For example, the most often cited case is the resistance to city groups or city banks for that example, that they were funding activities which were harmful to the environment or deleterious to the local project affected communities. So we had a conference of NGOs who were actually moving these issues forward. So from then on, we'll see that those problems have continued to persist, and the challenges which have beset Equator Principles have essentially come from two dimensions: internal factors, the absence of uniform application and implementation of Equator Principles, and then the issues of transparency. Know that, for example, that the Equator Principles simply provides the template for each signatory to tune or align their internal policies and procedures for Equator Principles implementation. But I think it's also important to note that in doing this, NGOs have persistently voiced the issues of transparency and differences of adoption of Equator Principles, because the nature of Equator Principles is that it's a self-regulatory body without monitoring and enforcement. So there are really issues of actualizing EPs on the ground, and of course, there are issues as well of stakeholder engagement. And so, in my field trip last summer, I did get some sentiments and opinions from those who were actually on the ground. One from a very senior official involved with Equator Principles. I think his point of view essentially was that Equator Principles signatories were not very serious in as far as implementing Equator Principles is concerned, because the issues of transparency and accountability have been an ongoing and persistent criticism. And then in my interview with an European-based bank doing a lot of project financing in Latin America as well, her opinion essentially was that the nature of the financial industry is that it's full of trying to keep everything within the confines of the operations from outside scrutiny. So transparency was an issue as well there. And then from a project officer involved with mining, the issue essentially was that even though EPs are embedded in financial documentation of funding, it was essentially to protect the banks in case of deleterious harms to the project. And so the critique of Equator Principles have actually emanated from three angles. In as far as Equator Principles governance is concerned, you note, for example, that the Secretariat is meagerly staffed, so they're not able to come up with adequate administrative measures to oversee implementation. And then you have to look at the institutional environment of Equator Principles financial institutions themselves. If you recall that the founding members were based in Europe and North America, in an environment where people at least were attuned to environmental and social issues. But once this was expanded beyond these regions, there was a problem really of implementing them, because the local people didn't really know what to expect of project sponsors. And then, of course, within that, you have what's known as the host country framework conditions, the issues of democracy and framing of policy around large-scale projects. And this has always been the case, for example, with World Council on dams. And so, as we can see, that beyond the democratic governance in a host country where these projects are located, the local people's participation has been limited or fragmented, in the sense that there's not been adequate communication between a project sponsor in as far as releasing environmental and social assessment documentation, and as well as handling of grievances arising from inadequacies or inaccuracies, or probably even incompleteness of consultation and participation. And then, of course, some of these projects are located in countries where democracy is just beginning to take shape, or to put it very bluntly, where their dictatorship. So the environment with which to engage freely in discussing these aspects is very limited, in the sense that going against the project is essentially going against the authorities in that country. And so in that realm, therefore, we see that getting effective stakeholder engagement is problematic in as far as it means interacting with the local people, or even getting the information from the project sponsor, or even from the Equator Principles signatories as well. So in this background, then, where do we go from here? My preliminary thoughts are that maybe in trying to evaluate Equator Principles as to their contribution towards sustainable development, maybe we have to look at how much chatter is going around in regard to Equator Principles. Are local people getting attuned to environmental issues? Are banks doing some internal reorganizations in the direction of Equator Principles? And then, of course, I think there's a need to go beyond just risk management. We have to come up with what's the model project for Equator Principles? What are the parameters with which we can say this project positively contributes to sustainable development? And then if we have issues with transparency and accountability, perhaps in addition to having Equator Principles Association in England, where apparently it's being hosted, maybe we should add now something like an Equator Principles compliance authority to oversee implementation and other issues in respect of accountability, so that we can therefore come up with specific parameters to measure performance, which of course will contribute towards a form of an independent assurance. And then currently we have supervisory organizations. Maybe they should also add sustainability aspects within their mandates to go just beyond ensuring monetary stability. And then we have to evolve ways of strengthening stakeholder engagement, whatever that entails, probably definition of what that is. So with that background, I would like to thank you for your attention, and I look forward to the next phase of this.
Okay, great. Thank you. I'm going to hand it over now to our two discussants, but first I just want to reassure everyone who is on the call, yes, there are about 40 people on the webinar. You can't see the attendance list, but we've had some messages asking if you're the only person on the call, and you're not. So not all the pressure for discussing this topic is on you. Chris, I'll hand it over to you, responses to Emmanuel's paper.
Hi, thanks. Thanks for the presentation, Emmanuel. Just to lay a bit more context from where my comments will be coming from, because I'm realizing the power of LinkedIn and the impact of not getting around to putting a profile on. I've been at EDC for 6 years, predominantly looking at matters of biodiversity and environmental and social impact assessment in the context of project finance in the mining sector. That's predominantly where I operate in this area. So I spend a lot of time looking at mining projects, and I've been able to pretty much have a look at projects all around the world to date. And prior to that, I spent a lot of time working with project developers on environmental impact assessment, sustainability programs, and getting projects developed and permitted. So that's kind of where I'm coming from. So there's a lot of interesting questions and points raised in the discussion today, and I think, you know, there are aspects that as EPFIs, Equator Principles Financial Institutions, we've been thinking about a lot. From EDC's perspective, a lot of what the EPs are trying to achieve in the commercial lending space, EDC's already had to have in place under our own environmental and social risk management policy in terms of certain level of disclosure and reporting and the process under which we take to review projects and make a determination on how they meet our standards. One thing that came out in terms of some of the points you brought forward in the paper that I'd be interested in a bit more discussion on as we go forward is in terms of EP8 that you bring forward and covenants and embedding compliance mechanisms in loan agreements. The discussion could benefit a bit more from the not only host country compliance, which as a financier, that's kind of the first line you need to cross. We're not going to finance a project that isn't permitted and approved as per the host country requirements, regardless of how robust the lending institutions may view those, because as noted in the principles, the IFC performance standards would then be brought forward as the benchmarking tool that would then be an additional layer to review that project and apply a standardized level of rigor to make a determination on how it's meeting environmental and social risk management, which includes all the elements we discussed in terms of stakeholder engagement, the adequacy of the EIA, and through that process, lenders using an independent reviewer for Category A and in case Category B projects will undertake a detailed review and develop mechanisms between the lender and the project sponsor who's developing the project on elements that they need to do to either address identified gaps or do additional work to meet those gaps. Because the Equator Principles are commitments that the bank is going to be applying and demonstrating that these are the guidelines that we're undertaking with that project sponsor, but it's the sponsor that has to go out and update and do whatever work is required to bring their product in terms of environmental and social impact assessment information up to a certain standard. And then that would then get translated, depending on what the outcomes were, into the loan agreement. So a bit of more discussion on how the loan agreements work and what the mechanisms are in terms of the ability and what EPFIs could do, and there's guidance documents related to this, beyond just saying, the bank is expecting that the project is going to meet the IFC performance standards or commits to doing that, and what level of detail, and the benefit or the risks associated with using ESAPs or environmental and social action plans to help carry that forward. So those are just some thoughts that came to my mind as I was kind of listening to the presentation and reading through the papers that might be good areas for discussion to find out where avenues are for making that process more robust that might help with the transparency overall. And I do take your point, and again, as I thought before, there is a gradient amongst institutions, and different institutions have different bench strength. And given that EP3 has just rolled out, we're at this process of finding out what those changes, how they're manifesting themselves in reality. That's just getting rolling, so it's difficult to really comment on how those changes are really coming into effect, and we'll be able to reflect on that in the coming years. Anyway, those are just some thoughts.
Okay, that's great. Thanks. Christy?
Can you hear me all right?
Yep.
Yep. Great. So yeah, I thought I would kind of situate this as slightly different, but situate the relevance of this work from the sort of investment practitioner perspective, so particularly the socially responsible investor sort of industry or perspective. And I think that the work is highly relevant and important. In the socially responsible investment field, the question really of whether the Equator Principles have genuinely impacted project finance, or whether it's been a case of reputational management, I think is super important, because the SRI industry is looking, is fundamentally a series of investors that are fundamentally looking at environmental as well as social and governance and human rights risks when they're managing their portfolios. And so it's typically investors investing in public securities of the company, so it can be the FIs, for instance, or it can be, like in the context of mining, the senior miners that might be acquiring projects, for example. And so on the institutional side, you have players like the pension funds who are looking at these issues, but then on the retail use side, you have a range of responses, or range of concerns, and all the way to the fully dedicated socially responsible investment funds that are specifically making decisions around either inclusion of what securities, which companies meet the grade around environmental issues, for instance, and how those companies are able to, not only the risks they have, but how they're able to mitigate them. And you've got kind of a bit of a spectrum where you have investors driven by more the value side, taking into consideration the risks around this stuff, versus the kind of values side, people worried about where their money is being placed. And so typically the investors are either looking at how these companies are doing on environmental issues and can be using the Equator Principles as a bit of a proxy for in some areas, are either screening, actually making decisions about what to include or not in their portfolios, or they're also doing engagement work, which is really important. So if they already own a security of a company that has exposure to Equator Principles, for example, there's an opportunity for them to then be engaging companies in their portfolios on how they might be able to improve. So the type of work in this research is just so critical, because the investors need a sense of where there may be gaps and where they might have an opportunity to engage the companies on how the companies can improve. So not only is it whether or not the implementation has lived up to those sort of founding purposes, but also I thought it was really valuable the notions offered up by the researcher as to how things might improve, because that just gives sort of the SRIs something to offer as potential solutions. I do agree. I think he really effectively outlined some of the difficulties in measuring this. So these attempts he's made, are valuable, not only drawing in the work of other researchers, but also his own on-the-ground research. It is interesting to note, sort of on the questions of the possibilities for novel governance institutions and the connections with the on-the-ground communities. Definitely, the socially responsible investment community has been very interested in questions around FPIC in a number of contexts, in a major way for quite a long time. And so I think that approach really is something that sort of can resonate with the socially responsible investors. I'm going to wrap it up by saying, yeah, I thought that actually I'm very interested in also in Chris's perspective with mining projects, because of course we have so much, particularly in the Canadian socially responsible investor context, so much exposure in our public company portfolios to mining, and so often these scenarios where the socially responsible investors are investing in the senior companies, but the senior companies are requiring on that pipeline of the junior companies and their projects for acquisition, and the seniors, the socially responsible investors are asking questions of the seniors around what kind of due diligence they're doing to make sure that the projects they're acquiring are meeting appropriate environmental standards, which again ties back in, not insignificantly with the Equator Principles. So yeah, I think this type of academic work is just great to be informing the work of socially responsible investors. Has a lot of potential. I'll end it there.
Okay, that's great. Thank you. So we're just going to take, we started a bit late, so let's have maybe 5 minutes back and forth, and then we're already getting some questions coming in. So we'll follow up on some of these things around mechanisms on guidance, FPIC, this idea around these novel governance. In the paper, you describe them as project sustainability associates, largely rooted in the NGO sector. So if we could follow up maybe on a couple of those points, and then we'll move to the questions in the chat box. Okay, Manu?
In my interaction, again, during my field trip, there was specifically this issue of stakeholder engagement, and one of the aspects which both the mining official or the project official in charge of Equator Principles indicated to me was that I think the local people didn't really have adequate command as to what environmental and social issues, where especially even the concept or indeed the self-regulatory mechanism of Equator Principles was really unknown in those places. So it seems to me that maybe the first approach towards this would be to engage what I preliminarily call project sustainability associates, and this would be associates who are at least cognizant of the workings of financial institutions and at least have some knowledge around sustainability issues, so that they kind of link with the local or project affected people in the sense that, they simplify, the complex world of finance and kind of wed it with, their social and environmental issues which affect people in those localities. Now, how would we progress with, first of all, this governance mechanism of project sustainability associates? One way would probably be to have project sponsors, along with government, fund the working of these project associates, and again, with larger stakeholders, maybe they could come up with at least delineate the roles and expectations from both, project sustainability associates and then particularly the local or project-affected communities. Because if you look at the aspect of environmental and social impact assessment, most of these tends to be really coming from the scientific or what they normally call the technocratic background. And yet even the local people, some of them have lived in these places for, their ancestors, if I could put it that way, they're buried there. They know the workings of the area. They know whether such a construction will be positive for the people. So I think introducing this aspect of project sustainability associates is extremely important because it strengthens stakeholder engagement. Consider, for example, that even though Equator Principles have been around for 12 years, most of these projects are located in areas where people are really illiterate, and some of this lexicon of environmental and social issues needs to be translated, first of all, into local languages, so that it's easy for people to really to understand, the complexities of the issues at hand here. And note also that from the governance level and on the national level, you'll see that whenever these projects are initiated, it's usually the government authorities or functionaries who come to the local project-affected communities. But it's like they're really coming to validate the project rather than really seek serious input from the local people. So those are some of the issues which probably project sustainability associates would handle.
Right, and I think it gets to one of Chrissy's points, and probably something that Chris is familiar with around now that there are large panels at PDAC and MAC on FPIC, on free, prior, and informed consent. It's not a debate so much about whether or not it's an issue, but it's how to operationalize it. I think that this notion about what are the levers and ways to actually put these principles into operation in ways that have real value in multiple ways is one way. And then one of the things in your paper, Emmanuel, you didn't mention also is this notion of using participation ratings as part of a proxy for measuring whether or not there is effectiveness from a local community perspective. I thought that was another piece. You didn't mention it, but I thought that was good. Is there just throwing it back to Chris and Christy, any kind of follow-ups on that notion of?
This is Chris. It's an interesting concept, and no question, this is a very topical and always an issue front and center in terms of this consultation, and was it appropriate, and do the stakeholders fully understand what the project is? Like, it's one thing to even provide some documentation in all the relevant languages of the stakeholders, but it's a difference between seeing a written description of what this project is versus what it actually looks like. So let's pick something really obvious and ugly, a tailings facility. It's one thing to say a tailings facility is going to cover 20 hectares. It's another thing to understand what that actually is. What is a tailings facility that covers 20 hectares? What is a impoundment dam behind a what is the impoundment behind a hydroelectric dam? What does it really look like? So that is a challenge and always a point of discussion. I do caution, it gets interesting because the Equator Principles, they're a framework to provide guidance to lenders when they're looking at projects. And the expectation is that the discussion is encouraging that project sponsor to come up to what the minimum standard the lenders are expecting. And if we look in the developing world context, that would be the performance standards as that line. And I know, this sounds like, okay, you're just defaulting to the text written that thou shalt benchmark the performance standards, but the point is that's providing the guidance that the lender is expecting the sponsor to do. And if the sponsor can't demonstrate, or the project developer can't demonstrate they've met that threshold, then they're essentially go back and continue to work until you can demonstrate that. In the area of consultation, there's an expectation that it's beyond simply just what the country minimum requirement might be, which is publication in a newspaper. And so to reflect on my earlier point about really ensuring that the proponents understand what it is and that they have meaningful engagement. The ideal is that they actually are participatory in the environmental impact assessment process. So what the idea is, we're trying to strive towards, get this to, a really high level by working with the sponsor. But the final point I'm going to make is a caution against, it's not the lending institutions that are to land on the ground and facilitate this consultation. That's they don't have the capacity, it's not their role. The project is the one being built. And so there's just that point I wanted to put on the table. And this is the way the lenders are trying to get comfortable that it's being done. And they either keep at it until everyone's satisfied, or in worst case scenarios, you just can't get there and the sponsor decides that they don't want to do that work. And then the lender can only push that so far because we don't have like a legal leverage in the country to make them do something. So in terms of these compliance officers, while it's an interesting aspect, what they're actually doing, to us, that's a community engagement officer from the company working between informing communities on what the project is and what the company intends to do and facilitate that discussion, as opposed to being, an arm of the Equator Principles.
Okay, so quick follow-up from Emmanuel. He's got a couple of things to say, and then we'll move to the chat.
Yeah. Chris, the other issue I just noted with your contribution there was that the aspect of lenders following up on participation on the ground, I think the EPs need to really try to revisit that, because if you look at the World Bank Inspection Panel, for example, or IFC Compliance Advisor, they are readily, they are readily available to take complaints directly from project-affiliated communities. But what the EPFIs have essentially done is to outsource this important aspect to project sponsors. So there's really a big disconnect there, in the sense that even though EPFIs have signed on to these principles, it's actually the borrowers who are supposed to implement this, and I find that kind of a little bit troublesome with the EPs.
Do you want me to respond to that?
Sure, yeah.
So just quickly, I hear you, and again, you're touching on this consistency amongst EPFIs and implementation. But, the independent review and monitoring role EPs are kind of caught in the position that, we need to demonstrate that we're not, in bed with the company from the, that it's this behind closed door negotiation and that everyone's making concessions. So they've implemented the independent advisory role, and it also assists EPFIs that have the reality is there's not a lot of institutional capacity within all the EPFIs to have people at every project. So the theory behind the independent review is they're acting on behalf of the lenders to provide an independent opinion and recommendation. And in really robust reviews, they are on the ground engaging with local communities, facilitated by whoever needs to be done to do that. So that's a mechanism by which that's done. But I do hear your point that it's not consistent, and it's a challenge for a lot of companies to be able to have this on the ground, or be able to send, there's only a certain number of institutions such as ourselves that are able to send people to projects to do, week-long audits of environmental and social compliance.
Okay, thanks.
Okay, great. So we have a couple of messages coming in on the chat box. I'm not sure, I don't see what you see, so can other people?
No, that's just between panels.
Okay, great. So we have a question from Ravindra. I'm wondering, and it relates to kind of global carbon markets. I'm wondering if a company wanted to offset the carbon footprint of a Western country by planting trees in developing countries, would it be possible under any guidelines, the UN, or possible at all? And I think that this question is a bit out of the range of this topic, and I can certainly send you some resources on that. But does carbon play into this notion around Equator Principles?
Well, the latest revision, EP3, has introduced a related aspect of where project sponsors must now report on carbon dioxide emissions to the tune of 100,000 units per year. Now, one of the things the principles, at least the revised ones, expect of project sponsors is to evolve what they call alternative analysis, or potentially, in other words, they want to come up with mechanisms in which to ameliorate or reduce, potential pollution. And so maybe the other way, and I'm not very familiar with the exact mechanism of offsets. Maybe one would be that if a project, maybe like let's just give an example, an oil refinery in some Western country would therefore be expected to, do some offset, plant trees in Zambia or in Uganda. But the question, I think, therefore would be that how do you go about determining, first of all, where to plant these trees and, that kind of stuff. I'm not very familiar with how that really works within EP3.
In EP3.
Yeah.
This will be
something
that rolls out.
Yeah.
Okay.
Yeah.
Great. So the next question is from Paige. Could using post-development impact assessments as a basis for continued finance help to engage the lenders in areas where regulatory oversight is lacking? So these kind of post-development impact assessments, what role do they play in engaging lenders in areas where the regulatory oversight that you're talking about is lacking?
Yeah. As I indicated in my slides there, one of the issues really against EPFI signatory is the issue of transparency and accountability. And one of it is that even these post-assessment reports are not readily available to local people or even stakeholders to engage with. So to the extent that is not forthcoming, I'm not sure whether this can still be something which would be operational in those environments where there lacks environmental regulations. So if the EPFIs can loosen up, can be transparent in their internal deliberations in regard to cost assessment, maybe the local people in those jurisdictions where there's lax environment, maybe that's something they can buy in. So it's I think it's something which I think goes to the core issues of transparency, first of all, within the EPFI. But it's probably something, if addressed, might help in those areas where there are lax social and environmental regulations.
Okay, great. So we have a hand raised from Alton. So we're going to unmute your line. Alton?
Hi, can everyone hear me all right?
Yes, we can hear you.
Okay, thank you. I feel very privileged to be here today. I'm an MBA candidate with the Schulich School of Business, York University. And thank you, all panelists, for sharing lives. And I have a question for Chris. I know EDC has adopted EP for several years, and I have followed several projects EDC has financed. I would be interested to know that in the process of the due diligence, the whole evaluation, what are the biggest challenges you face as an environmental advisor to the company? Thank you.
This is Chris. Thanks for the question. I'll just paraphrase as I heard it because the line wasn't totally clear. You're asking what are some of the biggest challenges when undertaking a Equator Principles review for a development project?
Yes.
Okay, so it's on many of the aspects that Emmanuel has brought forward in his paper with respect to understanding host country regulations in terms of what the project is doing to meet those and where the gaps are against the, in a case where we're using the performance standards as the benchmark mechanism, and then trying to figure out ways where gaps are identified, particularly between host country and performance standards, because you can meet resistance from both the project and at the country level of imposing additional obligations, and there's a variety of reasons for that. That could be, just to, keep this brief, a host country regulator takes exception to the fact that a external entity is coming in and imposing something more rigorous or more stringent on a project, and why are they doing that? So there's that, and then just working through fundamental gaps where against a project timeline. We come into financing transactions in an ideal state. We can come in when a project is just developing their ESIA, and we work with them along the whole process. It becomes much more challenging when you're coming in when a project is well into development or they're undertaking an expansion. It's a lot harder to come to an agreement on where we're meeting with respect to conformance to any standards that the lender may be bringing. So those are some top of the head challenges that we meet in terms, and then finally coming into agreement on what an environmental social action plan would be and how that would be worded in a loan agreement, because then lawyers are involved and it gets really tricky.
Okay, great. Thank you. So we do have a question from Stephen Fish here.
Yeah, I just wanted to get your response to this, Emmanuel, because as you were laying out some of the challenges to building compliance around the Equator Principles, one of them was that this is largely a voluntary initiative, and that's always been the challenge for all sort of quote-unquote CSR initiatives, is that they are voluntary, they're led by the company. And I wondered what impact decisions like the South African Security and Exchange Commission's decision to make disclosure mandatory will have on Equator Principles in the future, as more stock exchanges and security commissions say, no, we see this as core to risk assessment, and this isn't a nice to have anymore, this isn't voluntary, this is something you must provide us. will the Equator Principles be kind of caught off guard by that, or is this something that you feel that they could very easily adapt to and incorporate into the framework itself, and to the betterment of the Equator Principles? I'm just curious your response to that.
I think to the extent that the Equator Principle financial institutions are involved in the financial market, either through loan syndications or even through advisory, I think at some point they may have to really accept the requirements of those Security Exchange Commission rules. I mean, because it's very difficult. I don't foresee a situation where a specific EPFR can pull back if really this large-scale project is very competitive and provides very lucrative cash flows, and they need funding from other players within the financial market, which in any case are governed by, Security Exchange Commission laws. So I would think that eventually that might be one aspect where they might have to incorporate that within the EP. This is just evolving anyway.
Right.
Okay, so we've started a little bit late, but we do have one more question. We have a hand raised from Sheng Imai. So, okay, so your line is unmuted.
Okay, can you hear me?
Yes, it's a little bit disjointed, but let's give it a try, and if not, we'll go to the chat box.
Yeah, I had the question in the chat box, but it's for Chris. Has EDC ever decided not to fund a project, or after having funded one, withdrawn funding because of failure to comply with EP standards?
I'm sorry, that was fairly difficult to hear. Chris, did you hear that one?
Well, I'll try and paraphrase, and the questioner can just confirm whether I got it or not. So the question was, has EDC ever not funded a project because it doesn't meet the requirements? And then the follow-on to that was, have we got out of an agreement because the sponsor wasn't meeting the requirements? That
Great.
close?
That is matching what is coming up in the chat box for me. Yes, great work.
Okay, so just really briefly, EDC has a multi-stage screening process for when projects are first brought in. As you can imagine, a project finance request for very large projects at least, they don't just happen in a couple of weeks. They happen over a long period of time. And we have early screening because we actually don't want to be in positions where at 0 hour, our environmental and social advisory services group is saying we're just not going to get there because a lot of effort and work's been put in by many players to do that. So we put in as much effort and early engagement with sponsors to identify where we see risks or gaps and start proposing measures that would be required based on our opinion and opinion of independent advisors, if we've already brought them in at that stage, of what the gaps are and what's needed to achieve those. And, then it's an iterative process to decide between the sponsor and the lender. EDC is usually part of a larger group, so it's not just EDC acting alone, but we do advocate for our own interests with respect to our needs on environmental and social risk. And so through that process, if we start to get a sense that a sponsor just isn't engaged or don't agree with the view, things, you may choose to part ways on those grounds. Our view is to do as much as we can to try and bring projects along to at least move the bar along, as long as there's not significant residual risks that are impacting communities or the environment. Once we're signed on, it's a fairly detailed loan agreement is in place, and there's lots of legal mechanisms prior to calling an event a default for non-compliance on environmental and social grounds, and interim mechanisms where you bring a sponsor to bear on having to do remedial actions. So to date, we haven't got so far as to call an event a default. at least in my tenure here. We have done lots of work with sponsors once agreements are in place, when gaps or non-compliances may start to manifest themselves. I'll leave it at that.
Great, thanks. So there's a capacity building piece in there as well. That's great. Okay. I'm very conscious of time. It's 5 minutes past. We do have one.
There's another question.
There's another question on the line.
And I think Emmanuel
has a follow-up. So I understand if people have to leave, but let's just continue on for maximum another 5 minutes. So first we'll hear from Emmanuel in response, and then we have a hand raised. But anyone who has to leave, thank you very much for participating today.
I'm sorry to interrupt, but it's Christy, and I actually have to leave in a second, so thank you so much, and my apologies for jumping off.
Thank you. Thank you.
Great.
Bye-bye.
Bye now.
Chris, I had the issue of follow-up, where a borrower potentially breaches environmental and social regulations as per your financing documentation. Given the non-recourse nature of project finance or this kind of funding, is it your viewpoint as well that if you push your borrower to some limits in regard to environmental and social issues, there's really a danger that they can actually default on the loan? In other words, the literature suggested that there's not a lot of pushing against the borrowers for that specific fear. Is that what your experience suggests as well?
It is. I can't deny that would be very challenging because of the nature of all conformance tools that are in place right now with respect to environment and social elements. They're very difficult to demonstrate a breach, and a lot of sponsors, would continue to, or borrowers, to push back that they have had a breach, and they would, at least be motivated to demonstrate. It is not as clear cut in reality as a breaching a financial covenant or a operational covenant, because they are numerical. You can demonstrate that you didn't pay back on the schedule or you didn't build the project as designed. It's much more difficult to demonstrate that your community engagement program has gone off the rails and is not operating as you said it would. So it is very difficult discussions, and they're challenging to have and challenging to define. So that is definitely one area where, to a point I made earlier, and just in terms of specificity in loan agreement really pays off, and different EPFIs have different approaches, is how detailed you can be in a loan agreement so that you can point to specific things if you are getting into a breach scenario. But they're very difficult.
Okay, thank you.
Okay, great. Thank you very much for engaging with that questions, Chris. And Christy, who's gone. Our other question has vaporized, so I'm at this point going to call time. We started about 10 minutes late. We're ending about 10 minutes late. So in terms of the envelope of the event, we've hit it. Thanks for the people who stayed. I want to thank Stephen Fish, Executive Director at CBSR, Emmanuel, Chris at EDC, and Christy Stevenson at Purpose Capital. You will be receiving a survey link. It would be really helpful for us in terms of improving our program if you could fill that in. And also check our Twitter, Seaburn_CA. We will be having an update on the research snapshot for Emmanuel's paper. And again, thanks to EDC While they did not select the research, they certainly are helping us mobilize research of relevance to Canadian business.
And I believe a recording of this session will be available within a week's time. And so if any of your peers, if you're listening in and any of your peers are interested in the subject, please feel free to forward that on. That will be open source and available on cbsr.ca. I'm sure we can link that through the CBERN network as well. So there's a copy of it for forever and ever.
Okay, and I've had a request to repeat the CBERN Twitter, and it's at CBERN, CBERN_CA.
Perfect. Thanks for joining us, and thanks, Hillary, for bringing us this opportunity. Thanks, Emmanuel.
Thanks a lot.
Thanks, Steph, for coordinating.
Okay, great.
Likewise. Thanks very much, everyone.
Thank you.
Bye, Chris.